Let me ask you something. You go to school for 12 years, maybe even university for another 4. You learn algebra, you learn the periodic table, you learn about wars that ended 200 years ago. But nobody, not one single teacher, ever sat you down and explained how money actually works. Why your salary disappears before the month ends. Why your savings account pays you almost nothing. Why the harder you work, the further behind you seem to fall. That is not an accident. And by the end of this video, you are going to understand exactly why the system was built this way. And more importantly, what you can actually do about it. Here is a number that should make you stop scrolling. The top 10% of earners in the United States own nearly 67% of all the wealth in the country. The bottom 50%, that is over 160 million people, own just 2.5%. And this gap is not shrinking. It is getting wider every single year. Now here is the question nobody asks. Why? Is it because some people are smarter, work harder, get luckier? Sometimes, but mostly, no. It is because the financial system has a set of rules, and the wealthy know those rules. Most people do not even know the rules exist. Let us start with rule number 1, the debt trap. The average American carries over $105,000 in total debt. Credit cards, car loans, student loans, mortgages. Now here is the thing about debt that banks will never explain to you in plain English. When you borrow money, you are not just paying back what you borrowed. You are paying back what you borrowed plus interest. And that interest is calculated on your remaining balance every single month. Let us make this real. You put $5,000 on a credit card with a 24% interest rate. You pay the minimum payment every month, around $100. How long does it take to pay off? Over 8 years. And the total amount you actually pay back? Nearly $9,000. You borrowed $5,000. You paid back $9,000. That extra $4,000 went straight to the bank. Now multiply that by millions of customers doing the exact same thing, every month, for decades. That is not banking. That is a masterclass in legal wealth extraction. Rule number 2. Your savings account is designed to lose you money, not slowly, rapidly. Here is how. The average savings account in America pays around 0.5% interest per year. Sounds fine, right? Until you learn about inflation. Inflation, the rising cost of everything around you, averaged around 3 to 4% per year over the last decade. So if your savings account pays you 0.5% and inflation eats 3.5%, your money is actually losing 3% of its purchasing power every single year. In plain English, the money sitting in your savings account is quietly shrinking while you sleep. And here is the part that will really get you. While your savings account earns you 0.5%, the bank is taking that same money and lending it out to other people at 7, 10, 20, even 30% interest. They borrow from you at 0.5. They lend to others at 24. That gap, that massive difference, is called the net interest margin, and it is how banks make billions of dollars every year using your money, with your permission, while you wonder why you cannot get ahead. Rule number 3, the paycheck-to-paycheck cycle. Studies show that nearly 60% of Americans live paycheck to paycheck, not because they are bad with money, but because the system is specifically designed to consume your entire income before you can invest it. Think about the order of payments in a typical month. Rent or mortgage, gone. Car payment, gone. Insurance, gone. Groceries, gone. Subscriptions you forgot you had, gone. Credit card minimum payments, gone. And what is left? Almost nothing. So you never invest. You never build assets. You never get to the part where money starts working for you instead of against you. So, what do the wealthy actually do differently? Here is the single biggest secret, and it is almost embarrassingly simple. Wealthy people do not get rich by earning more money. They get rich by owning things that make money while they sleep. Stocks that pay dividends. Property that generates rent. Businesses that run without them. Index funds that grow with the entire economy. This is called passive income, or more accurately, asset ownership. And the earlier you start, the more powerful it becomes. This is because of something called compound interest, the same weapon banks use against you, but this time working in your favor. Let me show you how dramatic this is. If you invest $200 a month starting at age 25 with an average return of 8% per year, by age 65, you would have over $700,000. But if you wait until age 35 to start that same $200 per month, you would have less than $300,000. Same monthly amount, same return. One decision made 10 years earlier resulted in $400,000 more. That is the power of time in the market. And that is why banks, credit card companies, and payday lenders work so hard to keep you in debt. Because every year you spend paying them back is a year you are not building that compound growth for yourself. Now let us come back to where we started. Why was none of this taught in school? The uncomfortable answer is, financial literacy is not in the interest of the institutions that shape our education systems. Banks need borrowers. Credit card companies need spenders. Retailers need consumers. A population that fully understands compound interest, debt traps, and asset building is a population that is much harder to profit from. This is not a conspiracy theory, it is just business. And the best thing you can do is learn the rules of the game you are already playing. And this is where my colleague Lexi comes in, because there is actually a legal dimension to all of this that most people completely miss. Did you know that credit card companies are legally required to show you something called the Schumer box? It is a standardized table that must appear on every credit card offer, showing you the exact APR, fees, and penalty rates in plain text. Most people never read it. The companies are legally required to show it to you. They just make sure it is buried in the fine print, in the smallest font they are legally allowed to use. Knowing your legal rights as a consumer is just as powerful as knowing how to invest, which is exactly what we cover on this channel, the clause and the coin. So let us end with something practical. 3 things you can do this week, not this year, this week, to start breaking the cycle. Number 1, find out your net interest rate. Add up all the interest you are paying on debts. Subtract the interest you are earning on savings. That number tells you exactly how much the system is costing you every single month. Number 2, open a high-yield savings account. Some online banks currently offer 4 to 5% interest, 10 times what traditional banks pay. Your emergency fund should be there, not in a standard savings account. Number 3, start investing, even tiny amounts, $100 a month, $50 a month. The amount matters less than the habit. Time in the market is everything. The system was not designed with your wealth in mind. But now that you know how it works, you can start making decisions that work for you instead of against you. On Clause and Coin, I cover the money side. Lexi covers the legal side. And together, we break down the things you were never taught but absolutely needed to know. If this video gave you even one thing you did not know before, subscribe. Because next week, we are covering something that affects every single person who works a job. 5 things your employer is legally not allowed to do to you, and most people have no idea about any of them. See you then.